Hi, good morning, GVS here. Today this video is being recorded on 19 February 2026, just to give you the timeline reference. Okay, now I'll be covering about the multi-asset in a small case product in this video. Okay, now this was launched about 3 years ago, and it has given a CAGR return of around 19.72% as on date. These are gross returns on this model portfolio, which are verifiable on small case platform. Okay. On top of it, nowadays small case management has given us access to the auditors appointed by them, and we will be paying a nominal fee for them to audit the reported returns and give you an auditor certificate that will form part of the fact sheet. Technically, this is an independent platform. We have no access to even reporting of the returns. It's only small case that reports. But small case itself, now we have got a second layer of verification through the auditor. Of course, we will be paying a nominal fee. They will also, audit periodically our small case product returns, and then you get an access to that report also. So please read all the documents carefully before investing. Now, multi-asset investing, as you know, investment is across different asset classes like gold or a silver or a liquid fund or index funds. I still don't have stocks in this. Of course, recently I have added the real estate investment trust, which are more like a mutual fund in their own category. They pool money and then they get listed, they are traded. But essentially, it's a nuanced mutual fund only in a way, or an index fund kind of a thing. Not exactly a real estate index fund, but a trust. It's a trust, but it's a diversification. So the attempt is to diversify across direct equity, across real estate assets, across gold, and across liquid funds. That is the objective. Now, obviously, the balancing is done between. So in terms of the direct equity, we have a ETF in this. As of today, it is Nifty 50 ETF. I still don't have the Bank Nifty ETF in this, but they are proxies relatively. So some part of it is allocated to. So you are buying the market as a whole instead of buying the individual stocks. That is index investing stocks. Then you buy something in gold, you buy something in liquid funds, you buy something in real estate. In an opportunistic fashion, we change the weightages. So it's also dynamically balanced. Multi-assets are also dynamically balanced so that you move from one asset to another by changing the weights when a given asset class has seemingly higher valuations. So that's how we play the game and recommend you the change in weights from time to time. It has a lower volatility also because large cap index has the least volatility, so to say, amongst the stocks category. And liquid funds are, obviously overnight liquid fund, they have zero. There is no interest rate risk and all in them. So their prices are steady and you get that 5-6% per annum. These are used as a parking fund. You're parking your funds in liquid fund. It's like a pit stop. In a Formula 1 car, you see a driver waiting at the pit stop for refueling. Here we have to wait because the engine is overheated. The overheat is in terms of valuations, price earnings multiples and other returns and other factors considered. So when you are at a pit stop, you change the weight to liquid funds and other different asset classes if they are cheap or if they are reasonable at that time. And then once the market gives us the opportunities to re-enter, dynamically we use the rebalancing approach to get back into the index fund in equity space. That is how I handle the rebalance from time to time. But it's amenable to SIPs also. Unlike other products, stocks, because we keep changing the stocks, you won't be able to follow an SIP. But this product is amenable to SIPs because you are investing in the market. Sometimes anyway, when we do the rebalance, you are investing more in stock markets, stocks, you are investing less in gold. But for asset classes, you are investing something or the other at all time. and because of its low volatility, higher amounts can be committed based on your own risk profile. That is not within our domain. Of course, the entire recommendation is discretionary in nature. One small thing that I would like to submit to you is, while there was a lot of uncertainty in the past 1 year, market has not moved much and all that. Small caps have had a pretty deeper cut for the last 14-15 months. Mid caps also have corrected to some extent. Large caps have remained sideways. This particular product of multi-asset in the last 1 year, from now to last 1 year, has given around 23.83% gross returns. So that's also a comforting factor from my side, which I want, because we are able to dynamically shift from one asset class to another, and sometimes you follow a capital preservation approach. When the markets are overheated, or when you can feel the heat, capital preservation becomes important than any other thing. So it's safe to save your capital, and when the opportunities come, we can always get back into with higher weightage to say Nifty 50 or Bank Nifty or stuff like that, large cap stock. So index funds, as of now, this is ETFs. It doesn't have any direct equity stock, so to say, except for the REITs. So stocks, I may like to add one or two just to give you that additional alpha, but then it will only increase the volatility wise. Stocks have a higher volatility. It may just have a higher volatility, I'm not sure, because it's calculated dynamically, but it will give you higher returns potentially. If I add some wonderful growth stocks of high quality, it may just give you, so I may keep it to a smaller percentage of 5%, just to give you that additional alpha. Also, I may just come back to you once this ongoing correction is over at particularly at the small cap level and all. Stock level, we may find opportunities. Market, of course, is much more complex than a given stock. Okay, so with these parameters, read all the stock documents carefully, and then take a call. I wish you all the very best in your investing journey. Of course, all my guidance is discretionary. Yeah, thank you so much.